The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour on this 29th day of December. My pleasure to be here Monday through Friday. And what we're looking at here is the Dow is up 172 at 17,700. S&P is up 18 at 2075. The composite index is up 56 at 5,097. This is going to be interesting. We've got gold down. It's about unch at 1067. Silver is, I think it was up a tad. Yep, up 0.09 at 1397. High-grade copper is still stuck in that 2.50 area. And you've got, this is going to be very interesting. The dollar is up 30 cents at 98.22. Let me just grab the dollar right here, DXY. So the dollar is still stuck in this trading band, and you'll see that gold is just stuck in this trading band right now. Same sort of thing. Same as the TLT. Look, the TLT is pulling back. It's down $1.17. But what's really important is if you're looking at it in the weekly chart, it's just gone from the trend line resistance and it's on its way to the trend line support, and that support should, let me move this 120-minute chart away. That trend line support should come in at about the weekly chart, huh? So this week, 119.40s. Now, what's really interesting, what I mentioned to my subscribers on my opening call, that perhaps we're seeing the traditional aspect of where money is coming out of the safety of bonds and going into stocks. And that's going to be very important. Why? When we're looking at the overall picture, my contention has been that, from my experience, when stocks survive a September, October sharp decline and then come back and they start to rally, there's a real good chance that they will close the year close to, just about at, or even just a little bit above the year's high. And that would be very interesting. 18,351 was the Dow's high. Now look at this. This is going to be very interesting because DXY, because within the context of the dollar took from March of this year, the week of the 13th, where it made 100.39 as high, down to the 92.61 low of August. I believe it was August the 24th. Yeah, let me put that in here. That's 8, the week of the 28th, 15. And then what did it do? It ran all the way up to a fractional 100.51 in a cup formation. It went to 12 cents was the new high, 10, 11 cents, 49.51. Yeah. And what we've got now is a situation where it's pulled back. This is that dreaded H pattern where it takes out the low. In this case, it would be the high, right? And doesn't close there. So we're watching this real closely. Why? Because the monthly has made a fractional new high as well. And that high is leg C in the monthly. And still the technicals are very good. So I've been contending, and that was in my webinar that I did about a month ago, maybe a little more, where I had said that there's a possibility that the Dow, look, now I'm going to show you something very interesting. The Dow monthly chart, INDU, 18,351 was the high in May of this year. We pulled back very sharply down to the 15,370 level, although a 3,000 point down move when you're over at 18,000 is not such a big deal. You know, it's 18% or so. Is that right? Wait, 3,000 from 18,000? Yeah, so it's only 3,000 points of 18,351. And where are we now? We're at 17,700. Now, what's really important about this is that we're about to challenge this downtrend line. And remember, I just spoke about the dollar that made that fractional new high? Well, look what's happened. The Dow monthly, the Dow is now within 800 points, let's call it 900 points, of an all-time high. It could do that in a few weeks if this rally continues, and if this weekly chart that we're looking at so far is very strong, and that's that downtrend line right there. 17,850 is a breakout, 150 points to go for the rest of the week. We'll see. I don't want to push things too far, other than to say this is a really interesting situation, because within the context of the dollar having, the fact that the dollar has been rallying for so long, together with the market, doesn't say that because the dollar is going up, the market has to go up. What we can say is the two have gone up in the same direction. And therefore, we can just assume that there is a little bit of a relationship that says chances are that the dollar was leading the general market because it made its high in March. We made our high in May. So we're a little bit behind. And maybe we too are going to make a nominal new high. And that would be just above 18,351. Then we've got to be careful. That's kind of the way I'm looking at it right now. So I've gone through the numbers. I've gone through a little assessment here saying that if the Dow breaks those levels, it's very positive. On the downside, it's real simple. A close below 17,400 says, uh-oh, you're mistaken, buddy. This is topping motion, and we're going to be going down now rather than later. Let's go to Frank in Gloucester, Mass. Frank, how are you?
Hey, very well, Basil. How are you?
I'm well, thank you. And I got a little exercise today with that freezing rain that we had. I'm not happy. I'll tell you why.
Oh.
Because when the season starts off, I look at the season. I used to have to travel when I went out to teach and different things like that. And I used to always remember that when the first snowstorm came, if it was on a Monday or a Wednesday, if it happened twice in the next week or two, that's pretty much the way it was set. Remember that we've had periods where on weekends in the summertime it would rain one day and not rain the other day. And that would be the pattern for a long time. So I'm looking at this and I'm saying, gee, everybody complained about last year's snow because it was so big, but it was really light. Yeah, it was a lot of work, but you had to keep shoveling, but it wasn't icy and wet. Yeah. So we've just started off with wet and icy, and I'm not happy.
Well, so that's, those patterns, it's amazing how those patterns repeat themselves.
It's just, I always think of it as like the market. A pattern that repeats continues to repeat until it doesn't, but it can stay for a long time, just as a trend in place can stay for quite a while. So, all right, you want to look at?
I'd like to look at oil, and in particular at BP.
Okay, so we've looked at BP before, and BP was looking as if it was about for the first time to attempt a pretty good H pattern, which it did, and then it gave back a big chunk of it when it went from around about 30, spiked to 32 something, and then pulled back again to the 30 level, but it was 30 point, let me just check, I think it was 0.2 cents higher. So that was 29.90 was the low on the 14th of December, and 29.92, 2 cents higher was the recent low. And then it gapped up, and so far it's held the gap. Gapped down yesterday, and it sort of filled it. So, all right, question is?
Well, I'm still looking at this long term, along with a couple of other oil stocks, to try and grab a dividend for some income.
All right. So I did something for my subscribers the past couple of weeks, past a week or so. And we grabbed some stocks that were Dow related. One was in the Dow, one is not. And it was in a different sector. And the reason why I did it is because I like to look at stocks that have the potential for some capital gain as well as dividend. So let's look at this now. This is now in the integrated oil BP PLC ADS, trading at 31.80, down, up 9 cents. Now the question is, if it even has a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This has been a 13-week rally since the low that was made the week of the 2nd of October at 29.35. It hasn't broken it yet, and it has gone all the way to 38. I mean, that's a pretty big percentage gain. Yeah. But you are basically looking at this in a sense, at least in the intermediate term, we're talking 6 weeks to preferably 3 months or more, as a buy and a hold. That's really the way you'd like to look at it, right?
Yes, that's right. I'm looking for some income from the dividend, which is pretty high now. It's a 7.5% yield.
Is it up to 7.5? You see, the way I look at this is if you're going to take a 10 or a 12% capital risk, then no matter what the percentage is, unless it's 14%, and then that would be a very risky situation.
Yeah.
I think that you're looking at a situation where I would only initiate. Do you know when the dividend is coming?
No,
Let me see if,
I could try and look it up while you're talking, but...
All right, you know what? I'm going to look it up here. PE research. Oh, I just lost it. Where did it go? All right, try it again. Here we go. PE research, because that's really worth knowing. Okay. It says income growth, revenue, dividends, gross margin, gross net profit margin, -3. Well, none of the numbers are very good, are they? No. So it doesn't tell me. Oh, I thought I'd be able to do it quickly here. Pricing, volume, okay. All right, maybe someone in the den is able to do that.
Like February.
It looks like when? February.
February.
Okay.
Yeah, early.
So my thinking here is if it's February, see if it was January, I'd say to you they're going to give you some bad news. If it's February, by then there might be some stabilization and they can look at it a little bit more positively. Okay. So the way I would do this, what would you put as your stop? Let's just say I said buy a little bit right here at 31.86. I personally would not want it. Well, of course, I wouldn't want it to break 29.30, but that's 2.5 points. That's already pushing your dividend. That's almost 9% risk in capital. Yeah. So what would you do? I mean, would you want to stop? Is this one of those situations where you feel as long as there's a chance to get up to the 38 to 40 level, I'm prepared to hold it for 3 months? See,
I look at that. I'm looking at a monthly chart too, and the monthly chart has this massive volume candle a la Tom O'Brien back in 2010. And it's at the top of it is at about 28. And I look at it and I say, if it penetrates the body of that candle, it's probably going to test the rest of that candle. That's the way Tom would look at it with time.
Are we looking at the candle of June of 2010 that had a low of 26.75?
It has a low of 2092 on my chart.
You're going back.
Yeah, I'm going into 2010. It's January, February, March, April, May, June.
Yeah, June. I've got 26.75.
Oh, okay.
You know what? This goes to my volume. I'd like to talk about it. Can you hold on and we'll talk about it?
Sure, thank you.
Okay, folks, we're looking at BP. We're looking at the monthly chart, and there's a very fascinating volume explosive decline, and I'll talk about it.
It's true. Life is all about choices. At Everbank, they're making it easy for you to make a smart one with this special cash offer. Open a new yield pledge money market account with funds from another financial institution, or deposit new funds into an existing yield pledge money market account, and you could earn up to a $500 cash reward. And if you're opening a new account, you'll also get their new higher 6-month bonus interest rate, along with their yield pledge promise that ensures your yield will always be in the top 5% of competitive accounts at banks nationwide. Open a new account or add to one. It's your choice. To qualify, you must meet balance and other limited time offer requirements. Go to everbank.com/TFNN for details and deposit options, or speak with one of their banking specialists at 1-855-750-4051 for more information. You must act by December 31st, 2015 to be eligible. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back. Dow's up 176. S&P's up 18. And we're on with Frank and Gloucester from Massachusetts. And we're looking at BP. This is the integrated oil. And, of course, back in 2010, remember that was that terrible thing that happened with the oil spill. And, of course, a lot has happened to BP since. And it couldn't really get out of its own way. But what's interesting, Frank, is I don't know if you recall, I've got a technique that I talk about. It's called the Chapman Wave volume price spike. And what it says is if there is a massive, and it really has to be a massive volume spike on a very nervous market that is going to lower lows, and then it has a spike to the bottom in price with a spike to the top of volume, that's usually what I call a Chapman Wave volume price climactic spike. And in this particular instance, I would have done what I usually do, as said, and I think I did talk to someone at some point, and I said, the way I look at this spike is that even though it's a monthly, and I usually do it on a daily basis, and sometimes it works on a weekly, so I have no idea if it's going to work on the monthly chart, but the theory is that that kind of spike invariably allows you 28 days before you even come back to you should not come back and break the low. And if you don't break the low in 28 days, you could actually go for 52 to 56 days. And this is very interesting because what's happened is I've got a left side price time match, and that goes exactly to August, which said that by August, you should be testing 2675. Instead, it tested that was September. It tested 30.53. Next month, 29.35. And that 29.35 is held so far. And I'm seeing a W formation in the stochastic. That's saying to me that I know exactly what price levels to watch, because if it takes out the 39 low, closes under that on a monthly basis, that's going to be very negative. So what you really want to see with the arch formation that was just formed is that in the weekly chart, you want to see the stochastic and the MACD hold very well. They've done that so far. So here's what I'm thinking. Are you saying that you were prepared to have the stop as low down as the previous low that I was looking, not even the 26, but the 29.35 low?
Yeah, I think probably under the 29.88 is what I was thinking of.
Okay. Then I'm going to suggest to you, and it's just a dividend play. It isn't my favorite way of looking at dividends at this particular time. I'm rather looking at stocks that are not necessarily at their highs, but on their way towards at least recovery highs. I like that. And if that's the case, then what I would do if I was you, I'd start a position right here at 31.87. If it crosses 32.59, that's the high of the 24th, I would add another small position. So I'm basically having two small positions. The reason being, I'd like to go into the first week of January to see if 31, not even 29, but the 31 level has held as support. And if it has, then I think we need to talk again, because then I'm looking at something that says if we have an H pattern that goes to an M pattern, that's another arch formation. It doesn't even have to go all the way to the 37s, but even if it goes to 35 or 36, you want capital gain, you don't want capital loss. That's just my opinion right now. Right. You want both the dividend opportunity and the capital gain opportunity. So that's the way I would do it. Start a little bit now, and you can have your 1.5 points. I would not even like it. I would hope it's not going to break 31 by Tuesday of next week, but let's just say somewhere around there you have to reconsider whether you're going to add. I would not do the adding. I'd just small position. I'd wait for strength. I'd rather be buying strength here. And if it goes to 32.60, immediately you could even put a stop right there that you want to buy at that particular 32.60 level, another small position. So altogether you've got a 1/3 position, maybe a little bit more of what you really would like, but under a half a position. Why? Because I need a little bit of time. But if I see that in January, the week of if on the 5th and 7th of January, I'm looking at a stock that's at 33.80, I'm saying, great, now you can be expecting a second arch formation, and that could take you almost into maybe the next dividend period. That's the way I'd look at it. I hope that helps you.
Okay, no, that's fine. Thank you. Appreciate it.
Okay, and give me a call in about a week and tell me what you've done and how it's doing, okay?
That I will. Thank you.
Thank you so much, and Happy New Year to you. Thanks for calling. That's Frank in Gloucester. And, folks, we're going to go to a couple of things that I was asked about. Let me just double-check. I was asked about the VIX. So the VIX right now is trading at 16.07. It's had a gap down, but, it's had a gap down, gap up. I'm not too worried about that. What I am looking at is on Friday, if the VIX is still well underneath the 1761 level of the 9-period moving average in the weekly chart, if it's in the 16 or 15s, I think that's going to portend a nice first week of January. I'll be back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. Dow's up 181. S&P's now up 19. Now, this is going to be very interesting, and I'll tell you why. Disney comes out, all right? And they've got this huge success story with Star Wars. But wait a minute. You see this V-shaped pattern here? This is what I call the Groucho Marx eyebrows. Put the little eyebrow in there and a little eyebrow in there. This is a pretty potent V-shaped pattern that, when it fails, takes out more than a third of the V that was on the upside. You got to watch out, because if it starts to break down and then take out a half, it could go all the way back to the most important left side trough, moving average, or low. The low is 90, but the trough that we're looking at is 98. That's 9 points away. I don't know. But when I was asked about it about 3 weeks ago, what I'd said was that the chart pattern in the monthly said that candle, that smash to the downside and the recovery is more like an arch failure, because the MACD was very negative and the stochastic had gone way down from in the 90s to the 60s. At that point, it was in the 70s. And the question was, hey, with the movie coming out and everything, I said, really? I didn't even realize that there was a connection there. I'm not very good at that stuff. And then when I did, I said, well, I don't know what to tell you. The chart just doesn't look very good. And the weekly chart just doesn't look very good. And here it is. the good news comes out for Disney, and it pops to the 9-period exponential moving average yesterday, right between the 200-period moving average and the 9-period moving average, and today again, and each time it's failed. It's having a terrible time. Something's going on that is impacting Disney negatively internally. That's what it looks like. I don't care about billion-dollar profits here and there. It just says it's not being reflected in the stock. Not positively at this point. If all of a sudden in the next 3 weeks, you're looking at Disney having a cumulative effect, as people say, hey, wait a minute, this is going to just knock for a loop any negativity. It's just going to be such a big positive. You will see a Disney by the end of, before the end of January, by the second or third week of January, it'll be taking out this high of 114.75 that was made on the 16th of December. That to me would say, uh-oh, we're done with the V-shaped pattern. We've made it a second cup formation or V-shaped formation, and now it's going to go back and test a trend line. That trend line will be somewhere around 119. Boy, unless it needs to do that, and until it can do that, all I'm saying is the chart looks very poor, and that's interesting. So I'm going to do this. I really don't like to do it, but there's only way I can demonstrate something, and that is to bring it up. And that is we went long yesterday morning, UTX, and we expected that it could make a leg C, and if it did that, and it did a price time match, oh, I've got to move this to the right. Let me do that. Give me 1 second, space to the right. Let's go 17 just for now. Yeah, so that was the pattern that I'm looking at. And pattern I was looking at was we were down there. You had to cross the downtrend line, that falling axe formation. And if you did that, that should take you to resistance right at, that was yesterday, that would have been right at the 96.30 to 96.50 area. Today it spikes up, it's up $1.10 and 97.19 UTX United Technologies. Not a great monthly chart, but the weekly is starting to improve. And I said, you know what? We're owning a little bit more of the Dow and the Dow type stocks. We have one under the radar, one that virtually nobody even knows about, who even looks at or talks about, and it's holding very nicely, putting it almost into the category of a dividend stock. And what we're looking at here is this is acting well. The Dow itself is, look, the Dow's at 0.98. The S&P is only at 0.90. The Dow is actually leading in this particular environment. And that's a very interesting thing. It doesn't happen that often that the 30 stocks are leading by far the S&P 500 and the IWM 2000, the Russell 2000, and the New York Stock Exchange 2000 or so stocks. This is very interesting, and it tells me that the old school at this particular point is benefiting for some reason, and that the Dow has finally got a mix that is the most, how can I put this? This is the most balanced mix that I've seen in decades and decades. And I'll explain why. There's an index that nobody talks about because it's hardly ever traded. It's called the XMI, and that is the ARCA Major Market Index. I think it's only 20 stocks. And that's a real mix because it has like Philip Morris and that sort of thing. And that is lagging, but acting okay. It's not great. It's not horrible, but it's not as good as, let me just do the trend line here. It's not acting as well. Let me just do this before I say anything else. Yes, the daily on the left, weekly on the right, monthly on, no, weekly in the middle, monthly on the right. Now I'm going to just quickly go to the Dow, keep looking at the charts, look at the pattern. Huh. They're pretty much the same. All right, finally, the Dow has got a very similar mix to the XMI, and I've always liked the XMI very much because it is such a mix that it tells you for the Dow type stocks, the big heavy, these are heavy capitalized ones, that you're looking at something very important, and that is there's a nice balance. And if this index is doing well, it's saying that generally the market is a lot better than people think. This is my own interpretation. Now, in my Dow quartet, you've got GE, GE is acting very well. It's a 31.18. We're long GE. It's got IBM. Don't want to do anything with IBM, although I think it's going to act a lot better than people think. It's trading at 139.68 up to. The weekly is actually starting to improve a little bit. The monthly, you see, when we looked at BP with Frank just now, we're not looking at the same kind of monthly, even though IBM monthly is horrible. It's just starting to improve a little bit. And if you look at Triple M, the third one in my Dow quartet, leg B, it is improving. The monthly is actually a little bit better, quite a bit better than UTX. But I was looking at UTX more as, because it's one of my indicator stocks. G is my lead indicator for the Dow. I thought it was acting a little bit better than Triple M. Today, Triple M is coming back again. So this is acting okay. It's not a great pattern in the weekly chart or the daily, but it is acting okay. And then again, UTX. Look, UTX is, look at that, a nice spike, and it's improving in the weekly chart quite a bit. So overall, I'm looking at a market that says, hey, be very selective. And even within the selectivity, you'll find, and this is why I like the Dow and this XMI, is because there's a great balance there. But if you're looking at the IWM and you're being selective, you've got to pick the exact stocks that are working, because look, it is not good at all. And that monthly chart is saying, hey, watch that Roman candle there, because if you start to trade instead of at 114.51 right now, 54 cents, and instead of popping by Tuesday of next week to the 119s, you start to pull back, you got to watch that trend line. It's very close to the monthly trend line support. So there is a difference. If I go to the IYC, which I featured for my subscribers the other day, much better action. And this big spike to the downside to 99.84 in August after trading just one day at 140 and the next day at 99. This is just crazy stuff. 45, 50% decline. It's just crazy. And it's trading at 146.85 right now at 147. Even has a slightly better chart pattern than the Dow. This is the iShares of the United States Consumer Services ETF. This is important stuff. And now look at the next one, which is the RTH. Yeah, the season is done. And look what happened. It's up $1.09 today. The Market Vectors Retail ETF, acting way better than I would have expected. This is a great leg B. What are we looking at? We're looking at a market that says, within the context of possibly a weak January, we don't know yet, but it could be a weak January. So far, the move towards higher highs in December, this is what I said to subscribers this morning, we're still looking at the match between, let me just open this up a little bit. The reason why we've gone so long since a week ago Tuesday is because we were expecting that we're going to try to test that purple or pink channel, down channel resistance line. And this is just the same as leg B that we've seen before, all the way back from June, July, going into August. And what we're looking at here is 1, 2, 3, 4, 5, 6. 1, 2, 3, 4. We've extended the number of times we've bumped against that line. If there is a move by, I wouldn't be surprised if Wednesday is just a mixed day, kind of a digestive day. But if on Thursday there's a sudden rally and we take out that 17, I can tell you right now what it is. We take, what's the high of today? The high of today is 17,713. You take that out, you start to trade anytime in the next few days without breaking under 17,550, 17,520 support. Instead, you break out and you see the Dow at the 17,000. Is that possible? Let's call it, this must be a little extreme here. If it actually goes to 17,770s, 17,790s in the next couple of days, that's a break. That's a break of the resistance that should have been very powerful resistance. So and the MACD is just to cross positive. This is such an important phase in this particular market at this particular time. So I'm making a big deal. I'm making a big deal because it says the power of the MACD crossing positive, if it's able to sustain that and make a wide beta, that's the difference between the green line and the red line, the distance between the 9-period differential, and if the stochastic at 61% is able to go to 68% or a little higher, that's going to say, hey, you've made a B, and you can go to C and a D, and that will take you towards the 18,351 high. So that's the reason why I want to do weight, W-E-I-G-H-T, more towards being long than being short. And in fact, we now have only one short, that very long-term short that we're still holding, and we'll see what happens there. So I just wanted to go through that and explain my thinking and why it's very unusual that we have this many. And here's the other thing. When I have too many long positions, well, mixed actually, or positions altogether, they can be longs and shorts, you start to get very often you start to get a really choppy market. Hasn't been choppy so far. It's just been straight up since last Tuesday. So we're going to see what happens. Very important period. It's an important period because if we can move up enough, that starts to say, you know what, even if there's a pullback in January, we might be raising the base. And the whole thing about, I spoke about a little earlier on, the VIX index. That's very important. So let's do this. I had a couple of questions. Basil, would you be buying PG now? Now, PG made that peak D and E. Let me just, oops, I missed it. Here we are. Do it again. Click. PG. Procter & Gamble. I think it was Procter that took over Gillette, right? Because G used to be my a stock we always watched. It made a peak D, so Procter & Gamble in it's made a peak D in the Chapman wave at 81.23 on the 16th of December. Pulled back very sharply to the 78s and then rebounded to today's high of 80. Today is at 80.42. High was 80.56. I have this as a leg B. Here's another thing that Frank might be thinking about if Frank's still listening. You see, Frank, I prefer to look at the dividend stocks that are showing nice technicals. Look at the nice technicals in the weekly chart of Procter & Gamble. So it's not the same percentage yield. Maybe it's 4.3. I'm not sure. 3.9. I'm not sure what the yield is. But I think there's capital gain and yield here. And if it's leg B in the monthly chart, and if we found that the old style defensive stocks, not defense, but defensive stocks are acting very well like this is, then all I can say is that the downside maybe here is limited to the 72s. It's at 77, it's at 80.43 right now. So that's a sharp, that's an 8 points, a 10% decline. And the upside, I don't know where it's limited to, because if in leg B, it takes out 82.55, that was the high back in July, that's going to suggest that the next level of resistance is up at 85.44. So this is an important moment. Okay, so I prefer this type of stock. Let's just look at Kellogg. Kellogg. Did I do something differently here? Did I type something that I shouldn't have? So Procter & Gamble, health products. Okay. Now look at that, recycled. So it's A, B, C. Now it's back to a D. But look, the daily chart's very strong in Kellogg. It's in a leg E in the weekly chart. I don't know if this is an A/E, but it's in leg F/B in the monthly chart. All I can say is at all-time, I don't believe this, Kellogg cornflake is at all-time highs. I was saying to my wife the other day, we were looking at Rice Krispies, an ad for Rice Krispies. I said, can you believe that when we were kids, they had Rice Krispies? That's amazing. It's still going strong. F/B. So I would prefer to be looking at defensive stocks. So, all right, we've got a break coming up. Dow's only up 146, S&P's up 15. Be right back.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Learn how to trade options with swim lessons. Brought to you by TD Ameritrade. Think or swim. Next on TFNN.
Hi, folks, we're back. I thought in this last little segment that we've got, I want you to look at the Qs. Qs have broken out of all the different trend lines. The 120-minute chart made a peak after then a pullback, and now it's in a G/A, but it's still looking very strong. So at 113.91, up $1.38. If, in fact, it's going to break down, it would have to break under 113 on the near term. It would have to break under 113.60 to really start to give back a chunk of the gains today. My thinking is that so many people have missed this, that there's a lot of support. So if you've got short positions, and you just use your common sense, use some trading stops, because, the things don't go up forever. But when the trend is very strong to a particular side, sometimes it could become very whippy before it actually turns around. So that's what I'm saying. Got to be a little careful. I did get in the 10-minute chart a minor sell signal, but that's a 10-minute chart, and that it's not what you'd be trading if you're trading daily. But intraday, that's what I got. Now here's the other thing. QQ weekly, it looks to me like 101 I didn't type that in. 115.75 was the high the week of the 4th of December. 115.75. Did I say 115.75 or 74? 75. All right. If that's the case, what I'm looking at here, I'm going to double check it. Yeah, 115.75. You're at 113.91. I believe we will make a leg D in the weekly chart, and that's where we've got to be a little careful. So in this particular instance, it's a long way to go. Look, today's at 139 up, and the Dow is up 150, S&P's up 15. So you're going to have almost like another move like that, even bigger, to get to the 115.75 level. So I'm looking at this and I'm saying, okay, so far everything's on track. Everything that we looked at as positive has been positive, getting a little bit overbought on a short-term basis. But this is the end of the year, and fund managers are going to really be wailing. They're going to be saying, oh, whoa, I'm out of it, or a whole bunch of stuff that seems to be working. I better do some rejiggling of my portfolio. So you've got to watch this for the best stocks are probably going to go a little higher, and the worst stocks are probably going to go a little lower. It's kind of the way I'm looking at it, but there's a middle ground, and that middle ground says that the indices that are the strongest right now could remain the strongest right into Thursday's close, end of the year. That's the way I'm looking at it. So I'm going to wrap it up there because we've got the swimming lesson coming up. We've got programming all day today. So I hope you enjoy the shows. And most importantly, let me just do this one more time. So we've got that support here in the E-mini at 264. If it goes below 260, if it closes below 264, no, 260, yeah, between 264 and 263 in the next 30 minutes, you can see a retest of the low, the breakout low from the 20, all the way to 2060. I don't know if it'll give back that much, but you could see a give back of partial position there. So with that, I'm just about to say we're wrapping it up. No, I've got another minute to go. That's great. So now let's do this. I'll give you the parameters to look for today. The VIX index trading at this particular point, trading at 16.44. Had a nice bounce. Let me just do this on a short-term basis. You see this VIX, this is the 120-minute chart. I'd be a little careful. If there is a rebound, because so many people are actually, the way the VIX index spiked yesterday and the way the short-term trading index, which gave a fantastic signal again for today, the way that acted, there is so much negativity out here. People are just very negative. They're very nervous and very negative. So I don't know how much more downside there will be. It'll be quick and sudden if there is. But I'm thinking that a lot of people are going to use any decline to try to get a little bit in. So I'm watching the VIX index. It's at 1643. If, in fact, the VIX index goes to 1657 or higher, then this market will start to pull back further. And then if it expands into the end of the day, this market will give back a chunk. But if it just stalls here and then it suddenly starts to pull back towards the 1620s, I'd say, hey, be careful. The bias is really towards the upside. Hey, folks, stay tuned for the next.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,